How to make money from stocks, price growth and dividends. Imagine you buy a stock for $100. A year later, that same stock is worth $120. You made $20. But what if the company also paid you $3 in dividends during that year? Now, you didn't just make money because the stock price went up. The company paid you to own a piece of it. And this is where stock investing becomes much more interesting. Because when people talk about making money in the stock market, they often focus on one thing. Will the stock go up? But there are actually two major ways investors can make money from stocks: price appreciation and dividends. And once you understand how these two work together, you start looking at stocks completely differently. In this video, we're going to break it all down from the beginning. What actually makes a stock increase in price? What are dividends? How much money can you realistically make? Why do some companies pay dividends while others don't? What is dividend yield? What happens to a stock when a dividend is paid? And most importantly, how can investors use both price growth and dividends to build wealth over time? By the end of this video, you should be able to look at almost any dividend-paying stock and understand where your potential return could come from. So let's start with the simplest idea. Imagine you own one small piece of a business. That is essentially what a stock represents. When you buy a share of a public company, you become a shareholder. You own a tiny part of that company. Now imagine the company becomes more valuable. Maybe its revenue is growing. Maybe profits are increasing. Maybe it is launching successful products. Maybe it is expanding into new markets. Maybe millions of new customers are using its services. Investors see that growth and become willing to pay more for the company. And when the market price of your shares increases, your investment increases in value. This is called capital appreciation, or simply, price growth. Let's use a simple example. You buy 10 shares of a company at $100 per share. Your total investment is $1,000. A few years later, the stock reaches $150. Your 10 shares are now worth $1,500. You started with $1,500. You started with $1,000. Now you have $1,500. That is a $500 gain, or a 50% increase. But there's an important detail. You only realize that gain when you sell the shares. Until then, the $500 is an unrealized gain. The market says your investment is worth $1,500, but you still own the shares. And this is one of the most important ideas in investing. The price of a stock can change every day, but the long-term value of a business is what ultimately matters. Of course, stock prices don't always move upward. A company can report disappointing earnings. The economy can slow down. Interest rates can rise. Investors can become nervous. A recession can hit, or the entire market can fall. Your $100 stock could become $80, even if the company itself is still fundamentally strong. That's why investing isn't simply about buying something and hoping it goes up tomorrow. It's about understanding what you own and why you own it. Now let's talk about the second way stocks can make you money: dividends. A dividend is a payment that a company makes to shareholders. Think of it this way. A company makes profits. It has several choices. It can reinvest those profits into the business. It can pay down debt. It can buy back its own shares. Or it can distribute part of the profits to shareholders. When a company distributes money directly to shareholders, that payment can come in the form of a dividend. For example, imagine you own 100 shares of a company. The company pays a quarterly dividend of 50 cents per share. You receive 100 shares times 50 cents equals $50. And because dividends are often paid quarterly, you could receive another $50 3 months later, assuming the dividend remains unchanged. Over 4 quarters, that would be $200. Notice what happened. You still own your 100 shares. You didn't have to sell them to receive the dividend. That's why dividend investing can be so attractive. You can potentially receive cash while continuing to own the underlying investment. But there is something extremely important to understand. Dividends are not free money. A company doesn't magically create extra value when it pays a dividend. Money leaves the company's balance sheet and goes to shareholders. That's why the stock price often adjusts downward by approximately the dividend amount on the ex-dividend date, all else being equal. For example, imagine a stock is trading at $100 and the company pays a $1 dividend. The stock may theoretically adjust to around $99 when it goes ex-dividend. Real-world prices can move differently because the market is constantly responding to other information. So you shouldn't think, I'll buy the stock right before the dividend, collect the payment, and get free money. It doesn't work that way. The dividend is simply another way that the value generated by a company can be returned to shareholders. And this brings us to one of the most important concepts in investing: total return. Total return is essentially the combination of the change in the value of your investment plus the income you receive. Imagine you invest $10,000. After 1 year, your shares are worth $10,800. During that year, you received $300 in dividends. Your total economic gain is approximately $1,100 before considering taxes and other factors. That's an 11% total return. The stock price contributed 8%. The dividends contributed 3%. And this is why focusing only on the stock price can give you an incomplete picture. Two stocks can have completely different returns even if their price charts look similar. Imagine stock A rises 10% but pays no dividend. Stock B rises 7% but pays a 3% dividend. Ignoring taxes and assuming the dividend is received as cash, both produced approximately a 10% total return. But there's another powerful possibility: reinvesting dividends. Instead of taking the dividend as cash, you can use it to purchase additional shares. And those additional shares can potentially produce more dividends. Then those dividends can buy even more shares. Over many years, this creates a compounding effect. Let's imagine you own 100 shares. You receive dividends. Instead of spending them, you buy additional shares. Now you own 101 shares. Then 102. Then 103. The exact numbers depend on the stock price and dividend, but the principle is simple. Your money starts generating more money, and that money can start generating even more money. This is one of the most powerful ideas in long-term investing. Compounding doesn't look particularly exciting in the beginning. The first few years may feel slow, but over decades, the difference can become enormous. Now, you might be wondering, if dividends are so great, why doesn't every company pay them? Because companies are different. Some businesses are mature and generate large amounts of consistent cash. They may not have as many opportunities to reinvest every dollar into rapid expansion. Those companies may return more money to shareholders through dividends and share buybacks. Other companies are growing rapidly. They may believe that keeping the money inside the business can generate much higher returns. For example, a young technology company might take its profits and invest heavily in research, new products, data centers, employees, or international expansion. Instead of giving you $1 today, management may believe that reinvesting that $1 can eventually create several dollars of additional company value. That's why some of the world's most successful growth companies pay little or no dividend. It doesn't automatically mean they are bad investments. It simply means their strategy for creating shareholder value may be different. And this leads to another important concept: dividend yield. Dividend yield helps investors understand how much a company pays in dividends relative to its stock price. The basic calculation is annual dividend divided by stock price multiplied by 100. For example, if a stock pays $4 in annual dividends and trades at $100, the dividend yield is 4%. Simple. But here's where investors can make a major mistake. A high dividend yield does not automatically mean a stock is a great investment. Imagine a stock falls from $100 to $50. If the annual dividend remains $5, the dividend yield suddenly becomes 10%. That might look incredible. But why did the stock fall 50%? Maybe the company's business is deteriorating. Maybe profits are collapsing. Maybe debt is becoming a problem. Maybe the dividend itself is no longer sustainable. A high yield can sometimes be a warning sign rather than an opportunity. That's why experienced investors don't simply ask, "How high is the dividend?" They ask, "Can the company afford to keep paying it?" And this is where several important numbers become useful. Investors often look at earnings, free cash flow, debt, payout ratios, revenue growth, profit margins, and the company's history of maintaining or increasing its dividend. The goal isn't simply to find the biggest dividend. The goal is to find a dividend that is supported by a healthy business. Now let's put everything together. Imagine two companies. Company A is growing very quickly. Its stock price rises 15% per year on average, but it pays no dividend. Company B grows more slowly. Its stock price rises 7% per year, but it also pays a 3% dividend. Which one is better? There is no universal answer. It depends on the company, valuation, risk, taxes, time horizon, and what happens in the future. But the example teaches us something important. There are different ways to generate investment returns. Some investors prioritize growth, others prioritize income, and many investors combine both. For a younger investor with a long time horizon, growth may be attractive because there are many years for the business to expand and compound. For someone looking for current income, dividends may be more important. But even then, you don't necessarily have to choose one side. A portfolio can contain both growth companies and dividend-paying companies. The key is understanding why each investment is there. And there is another powerful strategy we need to discuss: buying and holding. Imagine you buy a great business. The stock rises. You receive dividends. You reinvest those dividends. The company continues growing. Your share count increases. And over time, the value of your investment can potentially grow from multiple sources. This is very different from trying to predict what the market will do tomorrow. You don't need to guess whether the stock will rise 2% next Tuesday. You are thinking about what the business could become over 5, 10, or 20 years. Of course, long-term investing does not eliminate risk. Stocks can lose money. Companies can fail. Dividends can be reduced or eliminated. A stock that looked attractive 5 years ago may look completely different today. That's why diversification matters. Instead of putting everything into one company, many investors spread their money across multiple companies, industries, or broad market funds. This reduces the risk that one investment destroys the entire portfolio. And there is one more thing people often forget: taxes. The return you see on a screen isn't necessarily the amount you keep. Capital gains and dividends can have different tax treatment depending on your situation, account type, and where you live. So when comparing investments, it's important to think about after-tax returns, not just the headline number. Now let's return to our original question. How do you make money from stocks? There are two major pieces to remember. First, the stock price can increase. You buy shares at one price, and if the shares become more valuable, you can potentially sell them for more than you paid. Second, the company can pay dividends. You can receive cash simply for owning shares, assuming the company continues paying the dividend. And when you combine those two sources, you get the bigger picture: total return, price growth plus dividends. And when dividends are reinvested, compounding can potentially accelerate that growth over long periods. But perhaps the most important lesson is this: don't buy a stock simply because someone says it's going up. Don't buy a stock simply because the dividend yield looks high. And don't assume a famous company automatically makes a good investment at any price. Instead, ask 3 simple questions. What am I buying? Why should this business become more valuable over time? And how am I expecting to make money from it? Maybe the answer is rapid business growth. Maybe it's dividends. Maybe it's both. Once you can answer those questions, you're no longer simply watching stock prices move across a screen. You're starting to think like an investor. And that's the real shift. Because investing isn't about finding a magical stock that makes you rich overnight. It's about owning productive businesses, understanding how they create value, giving your investments time, managing risk, and allowing compounding to work. The market will have good years. It will have terrible years. There will be crashes. There will be rallies. There will be moments when everyone thinks stocks are going to the moon, and moments when everyone thinks the market is finished. But a long-term investor doesn't need to predict every move. The goal is to build a strategy that can survive the noise. So the next time you hear someone say, "You make money in stocks when the price goes up," remember that that's only half the story. The other half may be sitting quietly in your brokerage account every quarter. Dividends. And when price appreciation and dividends work together, you get something much more powerful. Total return. That is the basic engine behind long-term stock investing. Buy an asset. Own a piece of a business. Let the business grow. Receive a share of its profits when appropriate. Reinvest when it makes sense. And give compounding enough time to do its job. Because the biggest advantage an investor can have isn't necessarily the ability to predict tomorrow. It's the ability to understand what they own and stay invested long enough for a good strategy to work. And if you remember only one sentence from this entire video, remember this. You don't make money in stocks only when the price goes up. You can potentially make money from the growth of the stock, the dividends it pays, and the compounding that happens when you put those returns back to work. That's the real power of owning stocks. And once you understand it, the stock market starts to look less like a casino and more like what it really is. A way to own a piece of businesses and participate in their long-term success.